Hello, I'm Roger Congleton, and this is Econ 201H coming to you from West Virginia University. And today's lecture is about time and really about how people shift resources from one period of time to another, or in effect shift their current resources from themselves to somebody else who has other uses for them. So to begin with, we're going to talk about the market for savings again. We talked about that briefly a few weeks ago, and today we're going to talk about it in a little more detail. Okay, so to begin with, there's the case where savers and borrowers deal with each other directly, or essentially directly. In that case, there'll be some prevailing market price for the loans, which we call an interest rate, and there'll be some degree of savings by people who are supplying savings, consumers, firms, financial institutions, that kind of thing. And there'll be people who demand those loans or demand those savings, who are borrowers of one kind or another. Right, so when you watch this video, be sure to take notes like you would in class. Since I'm not going to stop to let you kind of write things down, that's up to you to hit pause on your playback and take the notes that you think are appropriate at that point, including screenshots and things of that sort. So in that sense, you're kind of going to be a more active participant in this than in class, because in class, basically, I do all the timing in your viewing of these recorded lectures. The timing is up to you. Okay, the speed is up to me in a sense, because I'm just going to talk at roughly my normal rate. But you should take some time to take some notes, just like you would in class. It just makes the lectures far more effective, and so that's up to you. So in this situation, buyers and sellers are directly interacting with each other, pretty much like we've always assumed in markets for final goods. And that means that there's going to be one interest rate, one price for these savings. The savers will get that return on their savings, and the borrowers will pay that amount to have access to those funds. And what's happening in that type of exchange is savers are saying, okay, I do not need all my purchasing power right now to buy things that I want, and I can loan that to somebody else who needs that purchasing power to buy something else and is willing to pay me for the use of my purchasing power during some period of time, after which the loan should be paid back. So this would be something that's pretty similar to what happens in, say, the bond market. Although we do usually use financial intermediaries in bond markets, you can buy government bonds directly, and the intermediaries that kind of provide those services basically just link up buyers and sellers, and usually do so with a very small markup. And the markup is small enough that for a lot of purposes you can just ignore it. The other case is more common for consumer types of savings. So you still have that roughly same demand curve and roughly same supply curve. But in between buyers and sellers in this type of market, there's an intermediary that provides other services. Right, so this diagram should remind you of the tax diagram that we went through towards the end of part 1 of the course. And that's because geometrically it's the same. The difference is that third party is now the intermediary rather than the government. And that intermediary provides various services to both lenders and loaners, savers. And they have to charge a fee for that. Right, because it costs them time and energy and other resources in order to provide those services. So some of those services are a little bit like an insurance company provides, in the sense that they take on part of the risk of default from the person's borrowing the money. And in a sense, they charge savers for that service. Okay, or if you want, savers are in a sense buying the insurance role from the intermediary by receiving a somewhat lower interest rate on their savings than they would have if they could have directly negotiated with the borrowers, as in case one. As drawn, these intermediaries are making a lot of money. Okay, that rectangle that represented tax revenue in the tax diagrams, in this case would represent the revenue paid out to the intermediaries. And to the extent to which that's a profit or not, you can't tell for sure because it kind of depends on their costs, right? So the larger those costs are, the smaller the portion of that rectangle that turns out being their profits after providing all the background services required for their intermediary role in the economy. So if you put money in a bank, you know that the interest rate that you get is normally a lot lower than you have to pay when you take out a car loan or a house loan. And essentially that's what's being captured here. And of course banks have buildings and they have staff and they have people who try to manage the portfolios of loans to try to keep their risks down. But of course they can't reduce those risks to zero, and there's always some kind of rate of default that they have to take into account, just as an insurance company has to take into account the fact that some houses will burn down every year. And so that insurance part, in a sense they're absorbing the losses associated with those defaults. That's part of this charge, along with all the labor and capital tied up in the banking's physical infrastructure, the buildings, the software, the computers, the staff, and so on. So this way of thinking about savings and loan for many consumers is completely appropriate because basically they're getting often a really pretty small interest rate in exchange for the services provided by the bank, okay, including liquidity and other things of that sort. Whereas if they deal directly with the bond issuers in a financial market, as through like a stock company, the amount that they get is pretty much the interest rate that's being paid on the bonds. It's just a small premium for just that connecting up service of an intermediary in that type of market. There's no insurance being provided by the intermediary in those stock market types of cases. Okay, so that's partly why the difference exists between the interest rates that you get from your bank and what you have to pay when you take out a loan. So when we think about time, there's an interest rate aspect of the calculations that we assume that individuals are making. And there is some issue about which of these three interest rates is the appropriate interest rate to use when you do those calculations. And it's my opinion that for savers, you use this interest rate. For borrowers, depending on their primary source of capital, whether it's from the banking system or from stock markets, the interest rate would vary according to which market is the one they're borrowing in. And therefore, there are actually three interest rates, or even more if you think about adjusting for risk and inflation and so forth, that you might want to take account of when you do these calculations that we're going to call the present value calculations in the second part of this lecture and most of the following lecture that deals with applications of that method for thinking about projects and doing the things like cost-benefit analysis. So jot this down, and if you have any questions, email me, and I'll try to answer them within a reasonable amount of time, given that I'm traveling quite a bit in the next during the period in which you're supposed to be looking at the videos. Okay, so for the rest of this this lecture, what I'm going to be doing is introducing the idea of a present discounted value. So in the chapter on risk, the previous chapter, we introduced the idea of an expected value, which is an idea from statistics. This idea is basically from finance and from people who think about long-term capital projects in business or in government. So the best way to introduce the idea of present discounted value is to think about compound interest. Right, so if you put some amount in the bank or some other, or tied up in some other interest-bearing asset like a bond, and you go back and in 2 years, then the amount you're going to get back after letting the interest accumulate and compound will be FT, right? And that's just P, the amount you put in, sometimes people call it the principal, times 1 plus R to the T, where T is the length of time that you leave the account alone and let this compounding process take place. So for example, if P is $100 and R is 10%, then this looks like this. And you leave that money in for 2 years, and you'll wind up with $121 afterwards. And I picked 10% out just because I can do the arithmetic in my head with 10, and I can't do it with many other interest rates. Okay, and otherwise I would use a calculator or something of that sort to do the calculations. And then if you leave it in longer, of course, the exponent gets larger and larger, and the compounding effect gets larger and larger. So to think about present discounted values, you think about how much would I have to deposit today to have FT dollars T years from now. In the account. Well, if we use this formula here, if FT is equal to P times 1 plus R to the T, then P, which is that present amount, is equal to FT divided by 1 plus R to the T. All right, and this is sometimes called the present value. All right, so the basic idea is pretty straightforward. It's just taking the compound interest formula and working backwards to figure out how much you would have to deposit today to have a particular amount in the future, rather than figuring out what future amount you would have if you deposit amount P today and let it ride at whatever the prevailing interest rate is for T years. All right, so algebraically it's pretty straightforward. Conceptually it's also fairly straightforward if you think of it in this way. And the idea of a present discounted value is it provides a kind of common denominator or common basis for judging the current value of things that happen in the future that involve money values in most cases. So we can use this formula in a variety of ways. For example, if you think about this formula in reverse, this one would say that if I wanted to have $121 2 years in the future and the interest rate were 10%, then the amount that I would have to deposit today would be $100. And said in present value terms, that means that the present discounted value, $121 in 2 years, if the interest rate is 10%, is $100. Right, so present values are always a smaller number than the future value. And the extent to which that shrinkage takes place varies with the time period and with the interest rate, and this one being 10%. Now notice that the interest rates are not written down as 10 with a percent sign. It's done as a fraction, so 0.10, 1/10 is the equivalent, right? So this is the heart of the material we're going to be kind of going through, and I'm just going to talk a little bit more about that today, and try to get some of the basic formulas worked out for you. And I won't expect you to be able to derive the formulas for the exam, but I know that most of you are pretty sophisticated at basic algebra, and so won't have any trouble really absorbing this. So it turns out that the present value of a series of future values is the sum of the present values of each element of the series. Okay, this for most people is not intuitively obvious, although in a way it should be, because if you just think about it, if I wanted to have amount F t years from now, and I put amount in the bank to go out and get amount F, if I go out and just pull that money out, then the account balance would be 0 at that point. But if I wanted to have amount F t years from now and amount F2 t plus 30 years from now, then there are two different amounts that I would have to put in to kind of get those different amounts. And those in each case, it's just the present value of that future amount. So we can write that formula in a really easy way. And it varies with what mood I'm in, whether I use 0 here or 1, but I use 1 today. Right, so the sigma sign is just the summation sign, right? So that just means you're going to be adding up these numbers for all the possible little t's in this series. So the t's are going from 1, 2, 3, 4, 5, right? If I were doing a 5-year addition. If I were doing a 10-year addition, the t's would go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, so on. And so t is just the planning horizon, how far off in the future you're thinking about, or in some cases it's just, okay, well, some cash flow ends after some period of time. For example, sometimes a lottery, if you win a lottery, it guarantees you a particular amount of money every year for the next 20 years or something of that sort. And so in that case, the t would be 20. Okay. And this formula will deal with costs as well as revenues, or costs as well as benefits. And so you can use it for any present value calculation that you want to. It's just that there are a few formulas that are easier to use than this particular formula. And those formulas, unfortunately, are a lot more complicated looking than this one. And so what I've got in the online notes, the chapter notes for this course, is the derivation of that other formula that I think is kind of useful. And my plan is to introduce that formula in the next lecture, so that won't be part of today's talk. And so what I'll do here is just imagine, suppose that F1 equals F2 equals F3 equals 100. Okay. All right. The present value of the series it's just P equals 100 over 1 plus R plus 100 over 1 plus R squared plus 100 over 1 plus R cubed. So that's going to be a somewhat different number than 300, right? It's going to be a bit smaller. Okay, so without using a calculator, this one will be approximately 90. This one will be approximately 80, but not quite. And this one will be approximately 70. Okay, not exactly those numbers. If you punch the numbers into the calculator, you get a more precise series. But when you add those numbers up, 90, 80, 70, you really get 90 and 80 is 170, 80 and 70, not 180 and 70 is 250, right? So it's quite a bit, the number is quite a bit smaller when you take present values. And that's because of compound interest, right? So you're taking account of the fact that your money has an opportunity cost, that when you tie it up in the present, it's going to be accumulating interest through time. And so, again, to have this common denominator of the value of things in the present period just allows you to make sensible or rational or internally consistent calculations with respect to a whole series of possible future flows of benefits and costs, and do that in a way that it makes all the results comparable. The main weakness of the calculations is R, okay, which interest rate to use, and how stable is the interest rate going to be over the period of your planning. Right, so if the interest rate is completely stable, then these calculations are fine. They make perfectly adequate standardized values that you can compare and assess the relative merits of different courses of actions that generate different cash flows through time. But if the interest rates jump around a lot in a way that you can't predict, then you have to consider the risk behind this. And the way people typically do that is they will add a risk premium to R. Okay, or if there's going to be inflation and you want to take account of the inflation, and you might want to use the interest rate that economists sometimes call the real interest rate, and that's the nominal interest rate, the one that the banks say they're paying you, less the inflation rate in the period of interest. Right? In that case, the R's would vary through time because of inflation. The real interest rate might jump around quite a bit insofar as the financial markets don't fully take account of the inflation rate when they sell new bonds or issue loans. So this system becomes less precise, less reliable, and intertemporal long-term planning becomes much harder if there's a lot of fluctuations in the interest rates or in the inflation rates. And that's a topic for another course, really, not something I want to deal with in this course. But I want to mention it because you could have that in the back of your mind as a kind of limitation of this technique. The other limitation of this technique is that it assumes that consumers and other people making long-term plans, like firms, are relatively sophisticated. Right? To calculate just net benefits does not require a lot of sophistication. It just requires you to think in terms of costs and benefits. And as long as those estimates of costs and benefits are reasonably accurate, then you're going to behave in an internally consistent way, and on average you'll maximize your net benefits, whether that's consumer surplus or profits. And in many markets, that's a completely reasonable way of thinking about the way consumers and firms make decisions. When you start dealing with uncertainty, with the probability material that we covered in the previous couple of lectures, that's moving up a step from that, is saying, okay, consumers and firms and other actors in economic markets are sophisticated in the sense that they understand the notion of expected value and know something about statistics, assumptions that were not necessary just to do simple net benefit calculations when you're dealing with day-to-day kind of repeated purchases and repeated types of production. In this case, another type of sophistication is required, It's not entirely reasonable, but on the other hand, it does capture a bit about even, sort of in a sense, normal people, non-sophisticated purchasers and planners make, in the sense that they tend to discount the future to some extent and be focused more on today's results than on future results. And what this type of formula does is give you a systematic reason for that behavior. And it also shows that if you're being a consistent planner and you know what the interest rates are, and you have a pretty good sense of what the future payoffs would be, as you would with when you purchase a bond, say, then you can figure out what the present value of that bond is, or the present value of that investment is, or the present value of that plan of action is, in a way that's systematic and is consistent with the idea that money has an opportunity cost, and that opportunity cost varies with the interest rate that's relevant for that type of behavior. And with that, I'll end today's mini lecture, and next time I'll introduce the other formula, and we'll do some more calculations, which I'll have worked out beforehand, so you can see numerically a little bit more about how the formula operates. The lecture notes also cover most of this material. It's covered in a little bit different way. It's not developed in the sense that a lecture tends to emerge kind of in gradual pieces as we work through it. But I think you'll find that a very useful complement to the lectures we're going through in the pre-recorded series. So with that, I'll stop for today, and I'll be back with another lecture shortly.